Hi, Alden.
No,
Hi,
no,
Diego.
no. Happy Saturday, everyone. This is Greg Dixon here for the Notes Show. And today we're going to talk about how interest rates affect real estate investing. And we have Alden, James, Dr. Ivan, and Diego here. And maybe Alden, each of you can introduce yourself for about 30 seconds, and then we'll go from there.
Yeah, hey, I'm Alden Guardo. We're here in the market of Arizona, and I'm president of Silvercrest Opportunity Fund, as well as vice president of Win Mobile Homes and Mobile Mailbox Money. We operate in Arizona, buying and selling manufactured housing on personal property mobile homes and originating notes for the long-term passive cash flow that provides. So happy to be here today, Greg. Appreciate the time.
Awesome. James, you want to kick in there a little bit, or you're together though?
Yeah, it's relatively the same, but it all does start with Win Mobile Homes, which is our primary company, and that's what makes the whole mobile mailbox money and ultimately Silvercrest Opportunity Fund. That's what puts it all together, which is the Win Mobile Homes model.
Awesome. Diego?
Thank you, Greg. My name is Diego Giraldo. I've been working together with Dr. Ivan. Um, Basically, we have two partnerships. One is a mobile home park that was a non-performing promissory note that we got a hold of it last year. The owner allowed us to take ownership of the park and take over the payments, so she didn't damage her credit score and be clear from that. Also, with the note doctor in KVA team, we originate promissory notes. So the mobile homes that we are repairing, we put them on the rent to own. And that way, as people are paying rent towards home ownership, we create a promissory note to get more working capital and be able to do more notes.
That's great. And Dr. Ivan?
I am Dr. Ivan Terrero. I am the note doctor. By day, I am a practicing dentist, and I've been in real estate for about 20 years. Been involved in the note space for about 5 years now. And with Diego, we own a small mobile home park in Arkansas. We're also looking to acquire more mobile homes, more home parks in that state and in the South in general. And we are purchasing the mobile homes, rehabbing, selling them rent to own, and offering investors stable returns backed by a real physical property.
Okay, thank you very much. So we have a mobile home theme today. So Alden suggested that what we talk about today is what would lower interest rates do for real estate investing, both in Canada and the U.S. It looks like rates are going to be dropped from our respective federal banks, and what does that look for your investment prospects?
Yeah, so obviously, as interest rates start to creep down, prices go up. And here in the market of Arizona, we're in a hot market. You know, people are still active as far as transactions and purchasing single family properties. So honestly, it's an interesting time across the country. There's different pockets of action going on, and others heavily affected from increased insurance and things of that nature. Here in the local market of Arizona, we've got a shortage of residential property because during COVID, they stopped building and stopped issuing permits. So there's a shortage of properties here in the valley, as well as the millions of Americans that are on 3% mortgages. So on one hand, you got a mortgage lock and also a lock of quality, affordable housing coming out in the valley. I think average purchase price here in Arizona actually just hit like $450,000. I think there's a lot of people kind of waiting a little bit on the sideline while still having some good traction and transactions going on in the valley. Ultimately, I think prices are going to adjust and increase, could be anywhere from 10 to 15% here real soon. In September, I was talking to a mortgage broker yesterday, and he said, literally just from the words uttered from the Fed the other day of speculation of interest rates softening. People kind of started hitting the phone and seeing what their options were. So I don't know if you guys are seeing the same thing.
And I think Alden is absolutely correct in regards to that. We focus on low cost housing, and a lot of the other people on this panel focus on low cost housing. And ultimately, it has the driving effect is the mental emotion of the consumer. And when it hits the consumer market on regular single family homes, that reduces the amount of the inventory for the low cost housing market, as well as the demand actually increases because of the lack of inventory in the market. But it's all a mental game. And that's so true that just as soon as they say, yeah, we're the Fed, it looks like they're going to reduce it one time, and it could happen in uh, the last quarter of this year or whatever it is. Just having that conversation spurs interest and phone calls and demand, and with the the actual call demand, that helps keep at least prices where they're at and keeps the demand starts to pick up and pick up. As we handle low cost housing, it does have
Oh, it looks like we've frozen a bit here.
Got a little freeze. Low cost
definitely
housing
and
market's
frozen
a
up there
big
for
need for sure. You're kind of
Hey,
breaking in and
James,
out there, James.
He's back.
he's muted.
No,
You're
you're
back now.
muted.
Okay.
Okay.
Yeah, the low cost housing market is definitely, I think, an area of opportunity because there's a lot of people waiting on the sideline for prices to become more affordable, and it's not going to happen when rates go down, and all those people that are waiting for their desired purchase price to become affordable. That's going to be, I think, left in the wind for a lot of people. And where does that leave them? That leaves them to obviously the more affordable properties that may be available in that specific area. But I mean, with a high population density and a drop of interest rates, there's still going to be little to no options out on the available market, creating an opportunity, I think, for mobile homes. With the increased appetite of institutional investment houses in buying these mobile home parks and increasing the quality, I think it's now facilitating a higher level of secure housing for an individual that really conventionally wasn't looking at manufactured housing. Really, at this point, the people that we're talking to are looking at mobile homes or manufactured housing, in other words, because purely they can't qualify for real estate. Well, a lot of people are like, hey, I'm waiting to make a purchase for prices to become more affordable. That may not happen. We just saw a big appreciation bump during COVID, and the lowest interest rate environment that we've seen really in our recent lifetime. I don't think that we're going to see that again. And seeing as rates just hit 6.75 for the 30-year fixed, and just a small reduction in 0.25, getting under that 7% saw, I think, a good influx of interested buyers into the market, ultimately facilitating a more plateau, I think, of pricing softening in certain areas. So that's kind of what I'm seeing in manufactured housing. I think that it's a great mindset to see kind of where the market's going and the demand. There's certain markets that are growing still, even though the fear mongering on the television, in certain markets is really causing some softening in purchase prices. But that's kind of what I'm seeing.
We're seeing also, because our market isn't Arkansas, we're seeing a spillover from the Texas market, which is a higher market. We're seeing a lot of people that are being priced out of the Texas market move into the Arkansas market. So couple that with a possible decrease in interest rates, I think that we're going to see housing become more expensive. And all real estate is local. And like you're saying, with the fear mongering, there are actually some markets that are increasing in price, and making the affordability problem worse. So I don't know where we are going to wind up. And I think we're in a nice niche here with the manufacturing mobile home housing. And what is also occurring is that a lot of municipalities, they were against mobile homes in the past because they had a stigma, that now they're open to it. And I think it's because also that institutions are beginning to move into this space.
For sure.
Have you seen that in Arizona?
Yeah, like in the past 2 years, we saw a historic deal in mobile home parks. I think it was Cobblestone. They bought like 6 communities for ding, 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 the big number of $250 million for
Really?
6 parks. Those are institutional grade communities here, and they're all within like probably 10 miles of each other. So, that just goes to show that historically, these, parks were mom and pop, right? They were kind of people that were opportunistic, and they saw an opportunity in the market. They went and developed these parks in like the 70s. And, they weren't so much institutionally owned. Well, now with the unaffordability of residential purchase prices, the labor and material costs to build multifamily properties, the now on the back end to build that property, you have to charge a higher rent because of the labor and material. In the want for to try and facilitate affordable housing, that doesn't so much fit. Where does an institution go to hedge the market? They started buying mobile home parks because the long-term cash flow that provides, as well as not as much maintenance as an apartment complex. I mean, you got lots, and the tenants responsible for their lots, really just the infrastructure of the community, and roll from there. What better way for an institution, I think, while they're pushing people out of affordable home ownership and residential property, trying to own 30% of single family properties or maybe more by 2030. They're pushing people out all the way down to mobile home parks.
And it's funny that you speak about institutions. I read 2 weeks ago, I think it was, that now Warren Buffett and his funds, they're the actual largest mobile home park operators, and they're actually looking to buy more mobile homes that fit their criteria. And it's
News to
amazing.
me, for sure.
And again, in the last 2 weeks, I've seen a lot of mobile home opportunity income funds hit the market.
He owns
I'd have to
Clayton.
say some of them seem to me a little bit suspect after doing my further research, but it's the next wave in real estate investing, I think.
One of the brands that manufactures mobile homes is Clayton, and is owned by Warren Buffett.
Right. Arizona is actually one of the unique markets where there's been a moratorium. They don't allow. They're very restrictive. Every county, you try to develop a mobile home park, just getting the county to approve it. Most major markets, the Phoenix, Maricopa County market, going all the way north to, say, the Sedona, Flagstaff market, and Prescott Valley, and so forth, down to Tucson. Every one of those counties have a moratorium. So it takes years of approval to try to get approved for mobile home park development. So that's what drives the demand of the actual, the buyout of the institutions, because there is limited inventory of actual mobile home parks and RV parks. We saw an opportunity years ago, same thing, of, what is the subset of a mobile home park is actually an RV park, because the classic consumer in the market thinks of an RV park as something that is temporary, a temporary stay location. But we come to realize that even the RV parks are being used 365 days a year. It's actually a new subclass. You've got single family homes that are up here. Somebody's living in a house. That's their dream. Everybody's dream is to grow up, own a home, 3-bedroom, 2-bath home, get married, have a dog, have a yard. Great. It's become completely unaffordable. Now we have the low cost housing model, which is mobile home parks are becoming realistic. I think it was big in the 50s, 60s, well, not 50s, excuse me, 60s and 70s when a lot of them first got developed, especially in Arizona. Most mobile home parks were built in the 70s across the major counties. And from that, so we're seeing a turn from those houses that were built in the 70s being regentrified and and remodeled and freshened up and so forth, almost taking them down to the studs and bringing them back to life. And they're going to go another 50, 100 years. But so that's kind of this low cost housing class. Now there's actually a class that we haven't even really talked about, but I'm actually really interested in, which is the RV park model. And the RV park model is the pull-ins, like the fifth wheels and the Class C RVs, that people are actually living in those with families 365 days a year. So there's obviously pressure. And what is that pressure? It's because at the end of the day, the average consumer cannot afford the cost of living, of acquisition. So as you mentioned, this is all based off of interest rates. Interest rates are so high the consumer can't get approved for a loan, because it's all about how much can I afford and get qualified as a monthly payment. And if they reduce interest rates, there's this theory that I can afford to purchase a home that at X price, but as interest rates obviously go down, so goes up prices and go.
Yeah. So Bonnie and I have been living in a Class C RV on and off for about 7 years, and we've stayed in places like 6 months at a time. So, and the winters can be rough.
So,
Interesting.
Diego, you had something to say?
James touched a really good point. After COVID, many companies allow people to work remotely, and it's like a dream, like you said, for people to live next to a lake, or by a river, or on the beach, and be able to work from home. It's now possible, and it's not a real estate, so they don't have to pay the real estate taxes, because this is a vehicle. It's a lot cheaper. So it's like a dream for many people doing freelancing, or remote working, and being able to do their job and then go fishing. I was doing a mentorship in California by the end of last year, and we visited many community bankers, and they are so open to lend money on mobile home parks, because they already know that at some point, many of the hotels, apartment buildings, and communities in California started from a mobile home park. So they already seen the full cycle of being able to develop these communities to a whole city. And that's why, if you go outside, most of the banks don't want to lend money on mobile home parks, but in California, because they already know that process, they are wide open to lend money on mobile home parks.
And the funny thing is that,
Very
James, we talk about interest rates. I'm pretty sure that you remember when in the 80s when interest rates were at 18%.
18%.
And
Yeah.
Greg, and I remember when we bought our first home, we had to we did a cash out refinance, and we were tickled pink when it was 7.75
Right.
from, I think it was 9.9. It was close to 10%. And uh, I laughed when I was able to get a mortgage for my current house. At that time, the interest rates were a bit high, and again, I chuckled because it was 2.75.
Yeah,
So
yeah. That's
It's
almost
kind of,
free compared to 18.
to me, it's almost like free money, almost.
Yeah,
It's free
yeah.
money.
I
it's
think
really crazy, the reality of it. So even if we go back and look at that, because a lot of people on this panel are talking about mobile home parks, and that's really our specialty. That's our deal. But we do have to look ahead and see what's coming down the pipe, and that's why we're even having discussion of how is that going to affect us for interest rates. But as I think about it, I'm just going to use Arizona as a market. The average lot rent for um, mobile home lots within a mobile home park is approximately I would call it $800 a month. So that's for an all age park or 55 and older park. The reason why people are actually looking at the RV park living, that we see it, and I'm not even thinking about what you guys are mentioning, which is the mobility. Since COVID, people are very mobile and can work remotely. I'm still talking about the affordability of actually living for the average consumer. Say they're making $30,000 a year. Where are they going to live for 400 or $500 a month? It's gone. Historically, rentals in the market were $1,000 for a 3-bedroom, 2-bath house in the West Valley, say 1980 and newer home, standard home, $1,000 a month for many years, many years. Now all of a sudden that same unit is $2,000 a month, $2,000 to $2,500. So people have to find some place to live, and that's what spurs the interest. And I actually like being part of active discussion, because my brain, as much as we focus on mobile homes, there is other opportunities within the market, and multifamily, obviously, we know that that's an opportunity, but it's overpriced because there's so much demand and so much competition. But the RV parks actually are a really interesting thing, and I think that there's more discussion to be had on that, even though we don't participate in that right now. But our fund that we put together has the opportunity to acquire mobile home and RV parks. We're just waiting for the right deal and we look at multiple deals per month to see what makes sense for us and the investors that are behind us. So we are looking really actually primarily in the Sun states across the country, Florida market, Texas market, obviously Arizona, any market that obviously is investor friendly. I like the Arkansas market. We've had some active discussion about that market, and I think that there's viability there also.
No, you cannot come to this market. This market is ours. Please do not come.
It's sold out. Sold
That's
out.
our monopoly
just
now.
kidding. And I'd love to collaborate with you. We're actively looking again in our market, and if there's anything that we can do to help you, please contact us. So.
Dr. Ivan, we lost your video.
Yeah, we're definitely looking. We've had active discussion with other companies that own mobile home parks in that area, and it looks like the returns are obviously higher than Arizona market. Buying a mobile home park in Arizona, it's a classic number, like a 5% return. Well, we have to look at it. I try to look at it from behind and say, as we raise capital for a deal, say a mobile home park or RV park, we want to have a decent return for our investors. The group that we were talking with about a month and a half ago that had some deals, their returns, it's just they're just not hitting there. Where our current big program, which is our mobile mailbox money model, our investors earn anywhere from 10 to 14%. So we have a bigger, continuously growing group of investors that want to participate with us in that 10 to 14% model. And those are actually notes. So they're notes on properties that we've qualified the buyer, we've qualified the property. And it's actually a great business model. And we could take that to any market in the country. You guys had mentioned you do that rent to own model. It would be interesting for us to have additional conversation about that. And it's all relative to the state regulations and so forth as to what's the better model. Is it rent to own while the interest rates are sitting up here? What's the benefits of a rent to own model? What's the benefits of just doing an ownership model with a note, an owner carry note, and making that interest rate high enough that it's relatively the same as doing a rent to own model. There's tax implications, I'm sure, also of opportunities. So I think that would be a future good conversation to have.
I would like to answer that right now, and instead of going into the future, James. We focus on 3 sources of income. So we have active income, we have passive income, and portfolio income. So active income is doing the rehabs. That's money that we invest into a property and we get paid right away because we're using capital, working capital. Then when we do rent to own, and we don't have to do 100% rent to own, we have a portfolio. My wife and I have a portfolio of some mobile homes in Georgia also. And we have a combination of rent to own, traditional rental, long-term rentals, and also Section 8. So with that diversity of passive income, you always have multiple sources of income. The rent to own is just a way for us to give back to the community. People they have difficulties getting a mortgage, so we are allowing people who show commitment, that they show the sense of ownership, because that's a mindset. not all tenants have the mindset to be homeowners. So when we see people who are committed to make their payments and take care of the property, we allow them to get to the next level, which is the rent to own. So they earn that as a privilege. And so that's, again, that's our way to give back to the community. And there are many benefits to it because not just in the money side, but this, we are investing with a purpose. And at this, like I said before, once we create a promissory note for a tenant buyer, that's how we call the person who's doing rent to own. At the moment we create a promissory note for them to make a commitment to make payments and over time own the house, Dr. Ivan comes into play and he creates a promissory note to get an investor to buy that note. And that brings more capital for us to do the cycle again. So we go from active income, passive income, portfolio income, and we continue that cycle. So we are independent. We are self-sufficient.
Yeah, no, I like that. It really matches the owner carry when you do a rent to own, because obviously they're paying it down, and there's a relative give back to that. You're helping them out. We run the same actual model. It's just that it gets titled into their name. The benefit to us is that they won't call us if the toilet's clogged or whatever. They can't,
Exactly.
Same thing I'm sure you have when your rent to own model is that the tenant agrees to take care of everything, essentially.
Exactly. And I missed the point on taxes. When you rehab a house and you sell it outright, you pay capital gains. But if you do rent to own, you put that into time, and instead of capital gains, it's passive income taxes.
Our challenge is within our market, if we don't own the mobile home park, 99% of the parks that we deal with want to see home ownership. So they don't allow rent to owns. They don't allow rental only. We have a few parks that we work with, so we have a small rental pool. And the benefit of that is that a lot of those are fixed income people in 55 and older parks. So we're helping stabilize their monthly payout. Whether the lot rent goes up or go down, their payment stays the same. And that's a super huge win for that occupant, because they're on a fixed income and they're trying to figure out, what am I going to do? Where am I going to live for the next 10 years, 15, 20 years of my life before I get on in life to assisted care or whatever? So I don't know if you guys look at 55 and older market. We actually started doing this business model in the 55 and older market. And it's really been, for us, it's been a great blessing of helping people out get into home ownership. But we do some long-term, like what I call perpetuity rental programs, where we just set a fixed rate. And it's almost the same as a mortgage-based program. We just know we're going to get it back when the people move on.
It is very satisfying personally, because that's how I got started a while back. I actually purchased a mobile home, and the renter was down on her luck. And after renting for a year, she asked if she can buy the mobile home, and we sold it to her rent to own. And I don't recall someone being so ecstatic as far as being able to purchase our own place to stay. But it does give us, at least for me, it gives me a sense of personal satisfaction helping someone out stabilize their living situation. Anyway,
Have you
I
guys?
think with interest rates in mind, I think there's a lot of capital out there looking to make a decision on where to park their money. And we've talked about multifamily projects, we've talked about mobile home parks and things of that nature, and now the emotional satisfaction with a manufactured home note. And I think it's a big topic because with the sliding commercial interest rates that we are seeing from 5-year terms, we just saw the lowest interest rate environment in the country. There's still some deferred maintenance out there. So if you're wanting to go buy a multifamily property, there's still some sweat equity having to, re-perform some of those units, as well as, the potential inherent risk of a 5-year commercial loan, no telling what interest rates are going to be 5 years from now. And then you've got, you could go buy and flip a residential property on the side of a mountain. That's a sexy strategy, right? But there's, inherent risks with that as well, with the unaffordability of purchase prices out in the market right now. To cash flow a property for a long-term rental strategy, it's all under pressure, is my point. What better way right now in a environment where rates may go down in September, to start earning today in a note that's already cash flowing, consummated, and qualified. And you also get the emotional satisfaction of creating a homeowner. So, for all the individuals out there that may be watching today with capital on the sideline and they're watching interest rates, they're watching what the Fed's saying, it's hard to know where to go out in this market, especially here in Arizona. I mean, to buy a single family property and try and participate in a cash flow long-term rental is non-existent. Even if rates continue to drop a little bit, the prices are going to outweigh the cash flow, and that creates a problem for historic single family investors, I think.
And that you are correct. It's not just Arizona. I mean, across the country, they're not building the volume of homes. I used to be a home builder and small multifamily builder, and as Alden had mentioned earlier, the construction costs and costs of labor and costs of land and development and everything, it's priced out the market. So the average consumer, home ownership on a single family home has really just been priced out. And that's happening the same thing in the Midwest market. So even people that look at notes, there's a lot of note education companies that are out there that historically have focused on buy a note for $30,000, $40,000, $50,000 that's going to cash flow in the Midwest market, like Indianapolis and Chicago and Kansas City. Those deals are gone. They're no longer available. They're now 150,000 or 200,000. So we keep going back to those guys and say, hey, why spend $200,000 on one note in the Midwest market, say Indianapolis, where people are moving out of and trying to move to the Sun States? Why spend $200,000 on that when you can diversify your note portfolio and buy a qualified note in a dynamic top 5 market in the country like Arizona, and you can diversify that $200,000 into possibly 3 deals.
I mean, what better way to diversify and mitigate your risk right now out looking in the market, to try and buy a single family property and take on that additional risk. Maybe you're a business professional and, end up cash flowing, at a break even or whatever it may be. People, this is where it's at. Manufactured housing is a new frontier of investment strategy that not all that many people are talking about. And we just came off low interest rates, but it doubled what the previous rates were. Now certain properties aren't available to cash flow. In this market, the golden nugget of the investment strategy of a manufactured home note, that's personal property mobile homes with a secured lien and a qualified client that has a face rate, people, of 14%. To try and find a note on a residential property, a performing note at a 14% face rate, you can't find it. Why can you not find that? Because pricing inhibits the end user borrower from being able to facilitate paying a higher rate. There goes manufactured housing from an $80,000 to $100,000 seller carry loan that individual participates in as an end user borrower that matches market rent. So with the plateau of rents that we've seen and not all that many new products coming out online here in Arizona, that's where it's at. People secure a lien on a property and outpace inflation with a face rate of 14%, as well as the emotional satisfaction we were just mentioning. You're not a landlord. You're not having to worry about the toilets, termites, and tenants. The saying goes, why own when you could loan at a higher rate of return passive and create a homeowner with monthly or quarterly principal and interest payments backed by a lien. I think this is the new frontier, and I'm excited for the opportunity available here in the country, because there's not all that many people even talking about this opportunity, when Warren Buffett, as you mentioned, owns Clayton and Cavco as well as 21st Mortgage, just trucking away billion-dollar industry.
I totally agree with you, Alden. It's exciting that we are right here, right now, because this is going to be huge. We have a possibility to set up ourselves to be in the front line of this new wave.
This is a whole new frontier, and what's
Yeah.
I boiled it down to the other day, the things that are highly misunderstood and skeptical, as far as strategy, when people are not understanding what the available opportunity is, well, that's right where the golden nugget is. The pot of
Yep,
gold
yep,
is
yep.
right behind all the speculation and the misunderstanding. This is an institutional investment program, and while BlackRock and Cobblestone and blah 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 are paying stupid numbers and low cap rates on acquiring mobile home parks and see almost no value to above the dirt, when we're sitting here well knowing that even here in my market, I can quote 10% of housing is mobile homes. That's a lot of homes. We do maybe 70 a year. We're not even scratching the
The
available market.
surface, yes.
And I think that, if we need some further capital here to capitalize on the available opportunity, and with the non-competitive nature of personal property manufactured housing, this could be the new frontier, and we could be the major players in this industry right behind Warren Buffett.
Absolutely,
There's not
absolutely.
that many people facilitating this strategy, and that's why it's an opportunity for individuals watching here today, watching the Fed come out and talk about interest rates. You're speculative on what single family pricing is going to be. Listen, people, this is cash flow right in front of you to
Right there.
outpace inflation, backed by a lien, a quality asset. It's got a bow on it for you today.
Yep.
So, and I know Diego can agree. He's doing the same strategy.
And Alden, I want to add something back to the interest rate topics. I come from Colombia. I came 20 years ago. My first investment property was 18% interest. And I mean, people tell me, oh, because now with the mobile homes in Georgia, for example, we're charging 16% interest. In Arkansas, we're doing 17% interest. And people tell me that's too high. But I say, if you pay rent, the interest rate is 100%. How many people that have been here for 20, 30, 40 years paying rent and they have nothing? So it's better to pay a high interest just to get in. Once you get the foot in the door, like you say, you are part of that new wave that we are going to be the new frontier. And that's huge, as an investors. I say, if you don't have millions or billions, this is the entry level for us to get to the level like Warren Buffett and be part of this new wave. I totally agree with you, Alden.
I mean, with the individuals that may have, $80 to $150,000, right? They can participate in mobile home chattel loans and maybe do that once or maybe 2 or 3 times on manufactured home loans. You got 150,000, you want to diversify out in the market. If you're a conventional real estate investment strategist on buying single family properties, you're going to burn that on one deal. You bought one deal. That's not so much a diversification play. You got a lot of eggs in one basket. Well, what better
Exactly.
way to additionally diversify with balances on these notes from 50 to 100, as well as the availability to make almost double what you would make on a net operating income for a long-term real estate landlord strategy. What's the average rate that they make yearly, excluding appreciation? It's like 6%. You're making a 6% return happily because you're in a sexy strategy and you can say you're a landlord but you're making 6%, and you got these floating management fees, and your vacancy may happen in 2 years. Now you got a heavy turn and capital to put out an outlay. This fits that need for capital right now with the high speculation of interest rates. They hint that rates will go down in September. That doesn't mean rates are going to go down. At the same time, they're definitely wanting to spur, I think, some additional transaction base here in the country. So they're feeling pressure, but there's definite pressure out in the market from single family to multifamily. We see multifamily properties coming online here in the Valley, and those rental rates for a consumer are like $2,200 a month. Well, that's above average rental rates here in the Valley. So I'm kind of going on a light rant here, but I think we can all agree that even though that this is not a conventional sexy strategy, you're not buying a luxury real estate flip on the side of Camelback. This is realistic. The numbers actually make sense, and you're not having to worry about a 5-year strategy to buy and reestablish a multifamily property, and who knows what those 5-year commercial rates are going to be in 5 years from now. This is a income-oriented investment strategy that has a high base rate, and really there's not all that many avenues for an individual to acquire these types of products. Diego and the note doctor here, Dr. Ivan, just happen to do kind of the same golden nugget strategy that we do in a different market. This is the prolificness of this business and the ability to earn in a highly pressurized market, across all avenues. We just saw bloodshed in the stock market the other day, like 2-3 days in a row. People have cash available, I think, on the sidelines that may have pulled out from, their positions in stocks, as well as the directing IRA capability. We talked to Nate Hare the other day from Directed IRA. What better way to secure a diversification play at a tax deferred strategy outside the stock market and an alternative investment like a manufactured home note that's cash flowing higher than conventional strategies? That's the bee's knees right there.
The bee's knees. That's perfect.
All right, guys, I have another call, so I'm gonna have to log out real soon.
Yeah. So we should, yes, we should let it go. I've been putting your website addresses on the screen, and I'm going to put it in the chat. And Dr. Ivan and Diego and John and Alden here, you all have investment opportunities into these kinds of investments. And so I just encourage everybody to reach out and talk to you and find out what's available. So this is, as you said, Alden, is pretty exciting stuff.
No, for sure. And we're here on the most prolific channel, Greg Dixon's The Note Center. Great roundtable discussion this morning. Diego, pleasure making your acquaintance. Would love to put our heads together, see what further opportunities, because this is an open door of opportunity here in manufactured housing, and I'm happy to be here. So thanks again, Greg, and nice to meet you, Diego.
Nice to meeting you guys too, and thank you, Greg. You got this going on really good, and appreciate you.
Okay, thank you very much. So happy Saturday, everyone.
All right, take care.
Bye, guys.
Bye.